Welcome to Middle Market Growth Conversations, a podcast for dealmakers discussing the trends shaping the middle market. I'm your host, Carolyn Vallejo, and this is a production of the Association for Corporate Growth. We have a little bit of a recent tradition of kicking off each year with WhiteHorse Capital's Pankaj Gupta and Stuart Aronson. In the past, these conversations have provided a lending outlook for the year ahead and some extremely accurate predictions for how markets will take shape. And in 2026, we're hoping for more of the same. Pankaj and Stuart, welcome to the podcast.
Thank you, Carolyn.
Thank you, Carolyn.
We're happy to have you both back, but to begin, we want to get to know you a little bit and share some more information with our listeners about each of you. So Pankaj, we're going to start with you. For the listeners who might want a bit of a refresh, can you tell us about your role at WhiteHorse US and what you focus on there?
Sure. I am the CEO and head of our WhiteHorse Capital credit platform. We are a exclusively middle market focused lending organization focused on working with management teams, with owners of businesses, with private equity firms to provide them with all sorts of capital that they need to help their businesses continue to thrive and flourish.
And Stuart, same question. Tell us a bit about your work at WhiteHorse.
Yes, I am the chairman of WhiteHorse. Have been here for 10 years now, and I work closely with all the management team on both the deal flow and fundraising of the business. And as Pankaj highlighted, we're actively involved in a mix of mid-market sponsor and mid-market non-sponsor lending.
And just for a bit of fun, if either of you could learn any new skill in 2026, what would it be? Pankaj, let's start with you.
Well, the main skill that I would first try to figure out is actually a personal skill, which is how to navigate teenage children. So if anyone out there has any ideas and wants to hit me up on that, I would love to hear about that. Look, on a professional level, I think the biggest skill for me and for everyone on our team as we head into 2026 is how to expect the unexpected and how to navigate that.
And I think expect the unexpected might also be applicable for teenage children, I would guess. Stuart, what about you? If you could learn any new skill this year, what would it be?
Well, the good news is all my children are past their teenage years. So whether I did it right or wrong, I made it through that gate. I would say, candidly, we're navigating from a business perspective, very complicated markets. M&A activity, as we'll talk about, has picked up a little bit, but nowhere near as much as private equity firms and bankers had been hoping and predicting. And navigating the market to do the right types of transactions and might make the right types of decisions with competition of a lot of new money flooding in is a complicated thing to do. So even though I've been in the market for 37 years, this is a interesting time to be investing.
An interesting time, to say the least. Well, we're going to dive into this conversation today and hopefully give our listeners a bit of insight into the many question marks that are out on the market right now. So, Pankaj, we're going to start with you. We have sat down with you and Stuart before, last time back at the beginning of 2025, to take a look at the year ahead. And you both have a great track record so far. And so first, give me your thoughts on 2026. What are the major market trends that you're keeping an eye on?
Yeah, interestingly, Carolyn, I was thinking back to our conversation at the beginning of 2025, and I was actually pleasantly surprised that we were not too far off on a bunch of things. Things like moderate level of rate cuts, as opposed to, a lot of people at that time were thinking about it in the context of significant Fed fund rate cuts. We sort of thought that inflation would remain sticky throughout 25. And while it definitely came down, it hasn't sort of retreated down to the 2% levels that the Fed wants. A gradual pickup in M&A, a gradual thawing of the markets with the CEO and business owner optimism that existed at the beginning of 25. I think, the one area that, again, it kind of goes back to, navigate and expect the unexpected. When we had this conversation last year, the trade policy that was then implemented in March, April of last year was not clear. to anybody, including us. And that obviously threw things for a little bit of a monkey wrench as the middle and most of 25 unfolded. As we're looking at 26, look, there's a lot that we are focused on and keeping an eye on, ranging from if you start at the macro level, again, Fed, what's the Fed going to do? Who's going to be doing that at the Fed? That's going to have a big impact on obviously on rates, on cost of financing, on growth, and all of those topics. We're keeping an eye on geopolitical events. As everyone knows, as you know, all of the things that have gone on recently as it relates to, Venezuela, Greenland, Middle East, Europe, et cetera, et cetera. There's just a lot going on. And a lot of it is truly, at least from my perspective, I'm not smart enough to predict that or in the know enough, I guess, to predict that. But it's, again, being cognizant of things that can occur and how do you navigate that. And then from a more micro or deal perspective, Stuart highlighted or touched on it, M&A activity, we do think it's picking up. We do think that that there is a thawing between buyers and sellers and more deal making that is occurring. That's generally a good thing and will be a good thing for us and the companies that we work with. And the underlying health of businesses from an economic standpoint is generally pretty good. Businesses are continuing to experience growth as a whole, especially in the middle market. Businesses are expecting growth in 26. They're kind of forward looking, and KPIs and sort of all the indicators are generally pointing to health. And so that's a really good thing. So I'd say we head into the year with cautious optimism. And again, the caution stems from the lack of clarity into the unexpected that we know will occur over the year.
Mm-hmm. Right. Well, as you just mentioned, there is a lot going on. We are going to want to dive into some of those specific topics later on in the conversation. But first, we also like to explore how these market trends are shaping underwriting standards. So, Stuart, I'm going to turn to you. What are some of the impacts of 2025's economy that have made an effect on underwriting standards?
Yeah, taking it from where Pankaj was, where we see the economy for the mid-market being relatively benign, there's generally optimism that the administration, while unpredictable in many manners, is pro-mid-market U.S. American companies. That has led to a confidence of people to be underwriting aggressively. The aggressive underwriting is then exacerbated by the fact that a lot of new money has been raised in the marketplace. A lot of people have become aware that direct lending is a good place to be invested for the long term compared to a lot of other sectors. And so that has attracted investors from many corners of the globe and many different market sectors into the direct lending world. So with a supply-demand imbalance and a general confidence in the economy, we are seeing bankers claim add-backs, synergies, and cost cuts on deals, leading to very highly adjusted EBITDAs. The private equity firms that look at deals take their own view on those, but lenders generally, since they don't have the equity upside, take a more conservative view. But that more conservative view has shifted over 2025 and we think into 2026 into more aggression. Particularly, we've seen it on some cyclical credits where people have gone to surprisingly high loan to values. So we think it'll be a competitive underwriting market. And at WhiteHorse, we think there'll be plenty of good deals done where we may not love the price on those deals, but we think that they are good credits and worth investing in.
Absolutely. Okay. Well, I'm hearing from both of you a decent amount of optimism, which is great. So, Pankaj, I'm going to turn back to you. We're recording right now, still in the first month of 2026. So I want to take this opportunity to hear about the rest of your outlook for the year ahead. And I know you touched on some of that, but I'd like to go a little bit deeper.
From a outlook perspective as it relates to activity levels, we do think 2026 is going to be a bit of a rebound year in terms of M&A activity in the middle market. For years now, there has been a disconnect between, buyers and sellers of assets as it relates to valuations. We've seen that disconnect narrow, and based on conversations that we've had with everyone across the market, whether it be investment bankers, advisors, owners, CEOs of businesses, or private equity sponsors, everyone in all of those conversations feels like there is additional activity that is occurring, that will occur, and that the valuation gap seems to be narrowing. It's not perfect by any means, but it's narrowing. And so with a heightened level of activity, we're still dealing with the items that Stuart mentioned, which relate to a lot of capital has flown into the private credit space across the market, in the large cap market, but also the mid market. And so finding a way to pick and choose your spots where you find, good companies with interesting theses, where you understand that business model and that sector, and can, in a prudent and appropriate manner, deploy and invest your capital. And that's what we're doing. And so we anticipate this year will be a good year. We anticipate it being a growth year over 2025, a step function growth year over 2025, still not to the levels of activity that we saw in, say, 2021, which was a pretty active and pretty aggressive M&A market. We don't anticipate it getting back to those levels, but we do anticipate it rebounding about halfway in between where it has been and those levels. And then again, as I mentioned earlier, based on our portfolio, and we have over 200 portfolio companies across the middle market that we've invested in, based on our conversations with those businesses and with the ownership groups of those businesses, we think that the fundamental health of middle market businesses is pretty good. And so that, again, puts you in a little bit of a risk on posture relative to, a viewpoint that you're heading towards a recession, which, again, right now, we are not seeing the signs of or the indicators for.
Stuart, what about you? What are your predictions for portfolio performance specifically in 2026?
I'll start with the fact that I think there'll be less pressure on companies because I think interest rates will come down more in 2026 than is currently being predicted. I believe the focus of the administration on getting someone in to run the Fed that has a desire to cut short-term interest rates will result in more than a 25 to 50 basis point reduction over the course of the year. And obviously lower interest rates will help portfolio companies. As it regards different sectors and how they will perform in portfolio, we're optimistic on business services. We're optimistic on healthcare. We're optimistic on TMT. The one place where we think there may be portfolio pressure is with inflation staying a little higher than the Fed wants it to be, and the shorter term interest rates probably, if they come down, pushing inflation a little bit higher, probably not that quickly, but over 6 to 18 months. We do think the low and mid-end consumer, who has been pressured for years now, is continued to be pressured. And you've seen that in some troubled companies that have reported, including some issues in the restaurant sector. So most sectors we think will be pretty good in the portfolio, aided by lower interest rates as well. And only pressure probably in that sector I just identified. Pankaj, do you think there are any other sectors that we're highly concerned about right now?
No, I mean, I think you've highlighted the one that, we've spoken about a lot here internally. Look, there's obviously a certain other subset of sectors that we at least have some difficulties with as it relates to things that can be a little more volatile, right, in terms of the underlying revenue and or profit stream. Things that are, more kind of brick and mortar retail or consumer, restaurant related type sectors. But again, generally speaking, we're not seeing broad-based kind of sectors in decline.
The other thing we're being very cautious about, and we can talk more about it, is the impact of AI across a whole series of sectors, which takes companies that may have had good growth patterns historically, but puts them at risk, not only today, but especially as AI continues to advance over the next 3 to 5 years.
Yeah, we're definitely going to want to talk more about AI. But first, at the top of this conversation, we kind of mentioned the phrase expect the unexpected. There are still so many unknowns in the market today. So in the event of a recession or economic downturn, Pankaj, what would be your expectations for portfolio performance?
Well, look, there's two ways to look at projecting out portfolio performance in the event of a recession. One is, what I think of as the traditional way, which is companies that historically have had structures with financial maintenance covenants and more regular way documentation terms. Regular way meaning, there's not an ability to get assets out of the kind of the collateral pool or bring in additional debt pari passu or even ahead of the existing debt in a business. So basically, a company underperforms, it trips its financial covenants. The lenders at the top of the capital structure sit down with the owners of the business and figure out a solution that rights the ship. That's sort of the old way and the traditional way of lending. And in that scenario, default rates usually go to 2 to 3%. And usually there's about a 40 to 60% loss when there's a default. And so your overall default loss rate goes to, let's say, 80 basis points or something in that area. What I'm concerned with is how most of the market has operated, at least for my 30 years of being in this industry. But a lot of the market over the last 3, 5, 7 years has moved away from that. And what I mean by that is they've moved to covenant light structures where there are no financial maintenance covenants, even for companies that typically are much, much smaller than the historical norm of 75 million or 100 million of annual cash flow, but much, much smaller than that, as well as documentation terms that allow for these deals in these companies to then take assets and outside of the kind of the existing loan, raise capital behind that, or actually bring in lenders ahead of the existing lenders in order to raise capital. So what happens in those situations is rather than the traditional method of lender sits down with the ownership and figures out the solution and new capital comes in to support the existing senior lenders, it's sort of the inverse of that, where the ownership then goes out and circumvents the existing senior lenders. The default rates and loss rates in those types of deals, it's to be written, kind of where they wind up in the next recession. We're already seeing in the market, there's a lot of data in the market that defaults and losses on those defaults are much higher in those scenarios than they are in more traditional regular way structures and deals. And so that's what, is sort of the unknown. Now, the good, at least from our end, is that the middle market and where we focus and working again with private equity firms and with ownership and management and founders of businesses generally is still a market that is the old structures, right? Or the regular way structures, I should say, right? Where there's, again, appropriate protections for senior lenders, appropriate options for owners of businesses. And so in the next recession, we don't think that our portfolio is going to behave materially differently than in prior recessions. But I can't quite say that for the overall market where there has been a lot of this newfangled technology, so to speak, that is going to cause a higher default and loss rate.
Highlighting what Pankaj said, in addition to the weak documents, high leverage levels, and lack of covenants in the large cap market, you also have a lot of deals that are now being structured with contractual partial PIK. And when you add covenant light to partial PIK, that means the company is going to decline more and get into more trouble before it has a payment default, which will put even more pressure on the recoveries to the debt. Ultimately, when you add in partial PIK, no covenant protection, so that there's a delay in the payment default, and then you've got the risk of the owner of the company executing a liability management transaction and bringing in senior debt ahead of what the debt was that thought it was senior in the company.
I had said earlier that I want to touch again upon AI, which Stuart, you talked about briefly. Tell us a bit more about where you're seeing AI impact the companies that you work with and maybe even WhiteHorse itself.
Yeah, AI is amazing. In just the last couple of years, we have seen the impact of AI at WhiteHorse have a very significant effect on the efficiency and productivity of our junior staff. And whereas we are a middle structure with about 1.5 junior people for every transactor, we have now shifted to more of a 1-to-1 structure. So there's still a role for junior people, but they're more efficient, so you don't need as many. On the investing side, AI is a very complicated topic. There are certain areas where you've seen AI already have significant penetration and impact into the marketplace. On those situations, frankly, it's easy to duck and cover to avoid the impact and not get in trouble. But the real underwriting goes on understanding where AI is going in the next 3 to 5 years. And 3 to 5 years particularly because that's typically the time horizon for a private equity investment. So we're entering something, and 3 to 5 years from now, the private equity owner is going to want to exit. And the question is, where will AI have gone? So things that are not an issue today, where will they be? And as a quick example, we saw a company that reads radiology and CAT scans for the veterinary industry. Already AI can do 70 to 90% accuracy on those scans. And the thinking we had was 3 to 5 years out, that accuracy is likely to go up much higher and potentially lead to a conversion from humans reading those veterinary scans to more AI work. And that frankly spooked us on that credit. So that would be an example of the forward vision of AI and how we're trying to underwrite to avoid problems upon exit.
All right. And Pankaj, you're going to close us out here. You also mentioned earlier briefly about geopolitical topics, Greenland, Venezuela, the Middle East, Europe. There's a lot happening. How is all of this activity impacting the world of private credit?
Well, there certainly is a lot going on around the world in terms of the areas that you mentioned, and it feels like there is likely to be more that occurs over the course of 26. From a private credit perspective, especially focused on the middle market, and I know it sounds a little bit almost not believable, but the reality is a lot of it is noise, and it's just noisy in the lower and the middle market. And I think the reason for that, again, is, look, the businesses that we work with tend to be fairly U.S. centric businesses where you have U.S. operations, U.S. supply chains, U.S. customer bases. And therefore, while clearly the world is interconnected and there is sort of knock-on effect, the reality is the direct effect, positively or negatively, for a lot of the businesses, most of the businesses that we work with, is fairly minimal. And so, of course, we are very aware of and keeping an eye on all of the items that are occurring around the world and what impact that they may have as it relates to the companies that we look at and work with and invest in. But so far, our assessment is that the direct impact, again, in a positive or negative manner, is fairly minimal.
All right. Well, Pankaj and Stuart from WhiteHorse Capital, and I really appreciate you both providing your insight and your outlook.
Well, thank you, Carolyn. We appreciate it.
Thank you, Carolyn.
Thank you for listening to this episode of Middle Market Growth Conversations. If you haven't yet, please subscribe to the podcast on Apple Podcasts, Spotify, or wherever you listen to podcasts. This podcast is produced by the Association for Corporate Growth. Learn more about us and discover new opportunities to network with middle market deal makers at acg.org. For more thought leadership from deal makers, business leaders, and other experts, visit middlemarketgrowth.org. If you like what you've heard today, please rate and review the podcast. And finally, if there's a topic or guest you'd like to hear on the podcast, or if you have any other feedback you'd like to share, send a note to us at tips@acg.org. Thanks again for listening.